just another asset class, and I think every Black person should be invested in it. Um, Off the top, my biggest mantra as I've been doing this work for now 12 years is that VC is the wealth creation vehicle of the 21st century that real estate was for the 20th century. And so for me, for that main reason, we should largely be involved. And we have not been involved, and it's gotten a lot better over the last 2 decades. And I want more of us to be invested in this asset class. So a little bit about me. I've been an investor, an entrepreneur, advisor over the span of 25 years. I got my MBA at Georgia Tech, and my background really is in computer science at the height of the dot-com bubble. So I learned how to code at the advent of the internet. I have been on all the lists, and I've been in the press, but my passion comes from working with investors. I launched FM Capital Group in 2014. So 12 years ago, working with individuals and their families on wealth management, building wealth and managing their assets, and then became a proper VC. During that time, I've helped lead folks into venture capital and angel investments. I started angel investing when I was in business school in Atlanta. And so I say I became a proper VC when I joined Lofty Inc. Capital 5 years ago as Chief Operating Officer. Lofty Inc. is many of you might know Lofty Inc., early stage VC firm investing in early stage tech startups across Africa and the diaspora. And so we've invested in Flutterwave, Indela, Move, Wave, Alt School as Thunder, Chifa. So we've invested in a number of startups, over 150 startups since 2010. So we've really been building out the ecosystem, and I'm blessed and honored to have joined in 2021, launching the second fund vehicle, and we're now in the close of our third fund vehicle. So it's been a wonderful ride working in this business and in this asset class, working with individuals and then working with institutions. So with Lofty, we work with institutional investors as well as individuals. And in FM Capital Group, I've largely worked with individuals. So my career in investing I have worked with every type of investor, and it is a joy. Just a bit of what I want to get into. What is VC? So we're all level set, know the thing, my idea. I know everyone in the room knows what it is, but why it's so important, the PPM and what it means for founders. Okay, so venture is an asset class. So that's what, a type of investment that we invest in. The only difference between a venture capitalist and an angel investor, as you all know, is one is investing other people's money and one's investing their own in companies before they go public. So that's VC. VC really at the earliest stages, whereas private equity, it could be similar, but much more mature companies. So why I feel that VC as an asset class is so important. Well, let me throw it to you all as founders or even as investors. Why do you think it's so important, or as folks working in corporate? Why is VC so important? Just quick shout outs, if you can. Or Stanley, if anyone's dropping in the chat, what are they saying?
They help us raise money.
Yep.
I think it helps distribute risk.
It doesn't even leave his face.
Yes, that's the reason I want to delve into. So yes, VC is important to raise money for businesses, particularly when they're first getting started. But that point in particular is VC is super critical to the wealth gap. It's the reason why it is the reason why the wealth gap exists. It's because it is the best engine for distributing wealth. And so we're well aware of the wealth gap. This is the US. These are old numbers, but the gap is still very pertinent, unfortunately. But let's dig into why. So because Black people are invested, and just like any other ethnic group, it's actually where we're invested. So if you look at conservative assets like CDs, life insurance, savings bonds, you can see that in each of these conservative fixed income assets, the wealthiest Black families are actually more invested than all US households and even white households. So there is no gap in conservative assets and fixed income assets. We have money. I always like to say that we have money. We have money on the continent. Black folks, we have money. Okay. We're also highly invested in real estate. So if you look at your first home, if you have other properties, if you have investment property or vacation homes, Black folks, there's no gap when it comes to Black folks and everybody else. We're well invested, and we're not out investing our counterparts when it comes to real estate. This is where we start to see, this is the driver of the gap. So when it comes to stocks, this is where we have a gap, the gap. We're not even invested in bonds, commercial bonds. Okay, so stocks in more aggressive, faster growing wealth vehicles, this is where we start to see a large gap. And it's even more astounding in business assets. This is where entrepreneurship is. This is where venture capital falls. And this is where we are not this is where we are hardly participating. And the numbers have gotten more stark post-COVID. These numbers are before COVID. And so the biggest driver of the wealth gap is a lack of participation in venture capital, both on the funding side, but we rarely talk about as investors and on the investing side, and what does it look like in our own portfolios. So this is where I like when I speak to founders, because of my background, I really want to talk about how are you all investing, building your investment portfolios, because you do actually have business assets, right? Your business is your business asset, and you tend, or we, as I've built FM Capital Group, we tend to put all in on the business, largely because that's where we're told, and instinctually that's what it needs to be as we're building and we're making payroll and other things. But what does your investment portfolio look like outside of the business? And so I want to just get you to think about today. So the biggest thing obviously is to get invested and get invested in equity positions early. So not just for us, I mean, the best time to invest is today. If you have children, you should get them invested today as well. They have even more time than we have. So get invested early, and get invested aggressively. So I'm not saying abandon your real estate holdings and don't have, CDs and fixed income assets, but that just according to the charts, according to the Quartz research study that I just shared, we need to flip the ratio and the asset allocation towards equities in not just our own businesses, but in other businesses as well. So we help folks do that at FM Capital Group, which is a registered investment advisory based in California. We work, all of our clients are of the diaspora. We have a few in Nigeria. And this is what we are, where our niche is, that we add venture capital as another asset class to your portfolios alongside your stocks, your bonds, your real estate, your mutual funds. So I'll let you see that you can reach out to me or to my team there. So let's talk about the PPM. So as an investor across asset classes, I love talking about the private and public markets, because both are in tandem in the work that we do, whether you're working in VC as an investor or fund manager, or tapping the markets, the private markets as a founder for fundraising. It is important to understand what these markets are doing. So what happened in the first half of the year? So the markets closed yesterday. It was the end of the week. It was the end of the month, and the end of the first month of Q3, or the second half of the year. So markets are down. and this is taken from the S&P 500. The dollar is down big. I think the dollar had its worst week last week when the Federal Reserve on Wednesday signaled that they were going to increase interest rates. And typically that should be good news for a currency if you just look at the Forex markets. But for the dollar, it was taken as bad news because it was a signal that that the Fed might premature, I don't know depends on your point of view, but might be interfering with the strength of the US economy. There's a lot of thoughts about what the US economy, how strong the US economy really is. And I think that's really why the dollar took such a hit. I think we can continue to see that unfold in the dollar. And that means if dollar weakness continues, we might see the stock market start to flatline as well. So stocks were largely flat as we ended the month, and gold is actually down since we went through the all-time highs in Q2 above 5,000. Gold's been down, and Bitcoin, as I think everyone knows, Bitcoin has also been down as well. So it's very interesting correlations that are happening in the market right now. Now let's take a look at private markets. I mean, we invest in Africa, so we are always taking a look at what's going on in the region. But this is a different viewpoint. So a lot of data. We have several organizations that collect data on the fundraising side, but Steers has been taking a look at fundraising for African fund managers, and this is something founders need to take into account. Especially if you're raising from African VCs, or if you are building for the region, and you may be looking to time when you get out into the market. Commitments were down in Q2, and this is LP commitments to African fund managers like Lofty Inc. So our investors are investing less, and there could be a number of reasons for this. I actually think that we're seeing we're seeing new funds starting to close their raises, which is a good thing. So that means that actually means that there's dry powder ready to, or looking for companies and strong teams to invest in. So I find it actually to be a good signal, but it is a poor signal if you are a new fund manager or you're looking to launch a fund. This may not be the best time to launch a fund, but if you have been raising or you're closing, as we are, this is actually a good sign that folks are actually reaching their closes and getting more LP commitments in, and going to actually close on funds. If you looked at this data 3 years back, you saw a lot of first close happening, and no one was actually closing out their funds, and funds were actually dying prematurely. And so this is again a good signal that we're seeing funds actually get to their final close. And even though this 30% in the middle, this disclosure rate, is seen as a negative on the researcher side, if you read the Steers report, is actually this is part of the reason why, to me, it's a great signal. So we're not going to announce our fund closes beyond the first close. And so less disclosure to me means people are heads down trying to close out their funds. And we're going to hear several announcements coming in the coming months. We're going to hear more announcements, as I know friends have been working on their final closes as well. So I say this is good for the ecosystem. Well, it's good for the fund managers who have been raising for the last 2 to 3 years. So I'm excited that that's happening, that we will see new funds close out, hit their targets, or even become oversubscribed, which again, there's more money in the market than is being signaled by the numbers that people are disclosing. VC leads, great for early stage founders, early stage companies. VCs are raising funds, and they are leading in when we come to the mix of private capital that is out in the market raising. A few of these LPs here in the third bullet are LPs of ours, so they are indeed allocating. And then private credit continues to increase on the continent, which is a good sign for debt financing options and needs for working capital. As far as that money, how this being deployed, this is where it gets frustrating for founders. So we're not seeing what we're seeing in the early stages is a bulk of seed stage investing or seed stage fund managers looking for deals. This has left pre-seed quite underfunded when we look at the pre-seed stage historically. And there are reasons for this that I'm actually going to get to a little bit later. So just in terms of number, you can see in the Q2, the numbers are a bit down for where we were in Q1, but still on track to have a strong year when compared to 2025. So these numbers come from Techaball. And I don't think it's any surprise that strong unit economics and strong revenue numbers have been the metrics that founders have been using, investors have been using to select which founders and companies that they are deploying capital to. And as I said before, debt is keeps gaining share as we're seeing a lot more debt rounds being closed as well. So what I think this means for founders, and just in the context of building your own portfolio and what the markets are actually doing, I think there's a new way that you have to come to market. So I think number one is that you have to if you have to find a way to anchor your business to $1 trillion market opportunity, right? So in the chat, we started off by saying billions is the new millions. And I think that is the theme of Q2 2026. We officially moved from $1 billion and $1 billion market opportunities and unicorns. They don't even have a name for the $1 trillion companies. We've moved from billions to trillions. When you have a company who can debut on the stock market at $1.2 trillion, its first day on the market, and that's its valuation. We've had companies on the stock markets that have been around for decades and have just hit the $1 trillion market cap, or have even yet to hit the $1 trillion market cap. You can say globally, but clearly we're talking about US markets. It's a new day. It's a new day. And so I think actually what founders should keep in mind, instead of using AI as the buzzword that is put into your decks or used in decks, really think about the market opportunity. Can you communicate what is or what can be $1 trillion market opportunity? I think that is where you gain attention from investors, especially at early stages. And particularly if you're pre-revenue or you don't have the revenue numbers that investors are looking for at early stage, or at whatever stage you're raising at. So I think that is a mind shift that we all need to make. Right, we're no longer thinking of ourselves as millionaires. Now we're thinking billions. But when it comes to TAM and it comes to the addressable market size, investors have shifted into $1 trillion markets. And I think successful entrepreneurs are making those shifts as well. SpaceX did it. So you can blame SpaceX. So you can blame SpaceX. Now it's down 20% from its IPO price. And I'll tell you for free, I think it's going to go lower. But it does report earnings this week coming. So all eyes will be on SpaceX and the market's reaction to its first earnings report. That will let us know if this $1 trillion dollar valuation is indeed warranted, or if it's a farce and a scam, as a lot of people have said. But this is, regardless of how you feel about SpaceX and its founder, this is a historic moment in the markets. It is marking the beginning of our recalibration of what it means to be a large market opportunity. And I think it's important to recognize. The second pillar, or the second theme, I think why this is important for founders now is that there are fewer funds, though they are writing bigger checks. And so this is the implication that I was speaking about in terms of pre-seed and early stage funding. So I'm just going to take this is an ecosystem map. It's not inclusive of everybody, but this is something we drew up even like last year in our fundraising, like who is in the market and at what stage when we're looking at African early stage VC. And so a lot of these folks, I think you're either no longer in, if you look at the pre-seed, I wish you could see my cursor, but if you look at the pre-seed stage, many of those folks are no longer in the market, or they've moved up. They've moved downstream, and they've moved into seed and Series A. So even Lofty Inc., when we started investing in 2017 with the first fund, we were largely doing, even when I joined in 2021, we were largely pre-seed seed. I think many of you can attest to that. We were largely pre-seed seed, and then our friend Ingressa venture platform, we all played solidly in pre-seed and seed. And now many of us, with the close of our new funds, have moved up. So we've moved squarely in between seed and Series A. Now we're not even deploying checks at pre-seed anymore. We're saying like TL.com, who used to also be pre-seed, they're now very much Series A. Same with Partech. Partech used to be seed. Now they're much more Series A, Series B, right? So many of us are, those of us who are raising larger funds and writing larger checks are also doing so at later stages. And so this is leaving implications for pre-seed and pre-revenue companies that are building in Africa or for Africa. And there are conversations that, how do you bolster pre-seed funding when you're not having the liquidity events that have traditionally, historically, really have kept that flywheel going when those returns come back and then they're reinvested at earlier stages. So this is a reality that needs to be contended with as well, at least right now in 26. If you have less pre-seed funding, what do you have to do as a founder to bootstrap and build your company to the metrics that now your late seed Series A investors are looking for? And then while you're building, as entrepreneurs and founders, as you build the company, I want you all to start thinking about how you're building investing infrastructure within your firms, within your companies as well. And what do I mean by that? Establishing ESOPs or 401ks for you and your team through the business. Think about it now. It's kind of like, even if you're early, it's one of those things. It's like thinking about building out your board of directors, right? When it comes to governance and governance infrastructure within the business. I want you all to start thinking about how you're building out ESOPs. How do your employees participate in ownership, in getting shares in a company that they're helping to build? If you're more mature, you have the revenues and you haven't established one, thinking about establishing a 401k for you and your teams, especially if you have US companies and you're building in California. California requires it now that if you have I think it's 5 employees or more, you have to have 401ks. And there's ways to do it that are not cost inhibitive actually, because I've had to explore these as an entrepreneur with a firm based in California. But it's important. If you can't do those things, maybe you're not big enough, or your cash flow is not there, even just bringing in financial literacy to your team, helping them understand ESOPs, if you're thinking of or offering one, helping them to enroll in the 401k, things like that, just thinking about budgeting or putting aside money in savings and investing that, working with an investment advisor. I think all too often our community is told to invest by yourself, and that's not how the wealthiest invest. They have teams of advisors, family offices that invest their money for them. And so thinking about how you can leverage wealth and investment advisory services to help you on your investment journey, and and thinking about establishing, not only for yourself, but also your team, also for your family and your team's families. And there's different kind of accounts that can facilitate that. Custodian accounts, brokerage accounts, estate planning can help with this, so that your gains become generational and not just one-off. So I think entrepreneurs play a critical role in wealth building, because you are building one of the best assets for wealth creation, which is your business. And particularly at the earliest stages is when the most value is being created. And how can you leverage that for the benefit of not just your customers, but also for yourself and your families in terms of investing. So I will emphasize again, get invested, start early, and invest aggressively. You can work with FM Capital Group or others, and I'm happy to take questions from the audience and just gist at this time. Thanks so much.